lease, or buy your next car. Making the wrong call can cost you thousands. In this video, I'll show you a Microsoft Excel model that compares both options and gives you a clear, defensible answer in minutes. Most comparisons only look at monthly payments, but that's a mistake. The real decision depends on other factors: cash flow, equity, residual value, buyout options, and your time horizon. And the right decision is not always obvious. That's why I created this tool. It runs all the calculations, so you don't have to. The model takes real inputs and runs 4 scenarios. The scenarios are: purchase with loan, lease and return, lease buyout with cash, and lease buyout with loan. The model calculates the net present value of all relevant costs and gives a recommendation based on your inputs. Let's look at the model and see how to use it. On the input sheet, enter general information about the vehicle, including the time horizon, or the length of time you plan to keep the vehicle. Also enter the MSRP, negotiated price, and the expected retained value at horizon end. An important part of the lease buy analysis is taxes. The model will populate default tax rates based on the state selected. These should be checked and overridden as necessary. The next section is for the purchase loan. Enter the annual percentage rates for various loan terms. The dealership or financial institution will provide this information. Next, enter the specific loan information for the scenario you want to analyze. Now we move to the lease inputs. The general lease settings include the term, allowed miles, the residual percentage, and the money factor. Again, the dealership will supply this info. Don't forget to include lease-specific fees, both capitalized and upfront. And that's it. Let's scroll to the calculated metrics section. Here, the most important information is clearly summarized. You see total amount financed or capitalized, the applicable loan interest and money factor rates. Further down, you see monthly payments, upfront costs, and residual and retained market values. Next are the results and recommendations sections. The net present value results are clearly shown. The adjacent column includes an intuitive cost per mile based on the expected miles driven over the horizon period. And finally, there is the recommendation. Let's look at 2 examples: a Ford F-150 and a Toyota Tacoma. Both are popular pickup trucks and personal favorites. For both vehicles, we'll use a 72-month horizon, matching the loan term of 6 years and a 36-month lease. Their discounted purchase prices are about the same, and the loan and lease assumptions were taken directly from dealer data. For the Tacoma, I used actual numbers emailed from the Toyota dealer. They matched the values in the model. For the F-150, the figures were sourced online. A quick note about retained values: these are simply estimated market values at the end of the period. The model provides defaults, but you should always adjust them based on your research. Some vehicles hold their value better than others, and that can significantly affect lease buyout results. In this comparison, I've assumed 80% retained value for the Tacoma and 70% for the F-150. Now let's see what the model recommends. For the F-150, the best choice is purchase with loan. Its net present value is lower than a straight lease, and a lease buyout doesn't make sense here because the residual value at lease end is higher than the estimated market value, so there's no equity to capture. Extending with a second lease to reach the same 6-year horizon also costs more overall. For the Tacoma, the model recommends lease buyout with cash or lease buyout and refinance. A straight purchase comes close, but here the residual value is lower than the market value, creating equity for the lessee and making a buyout the smarter play. These examples show how scenario testing helps reveal small but meaningful differences, so you can make clear, data-driven decisions, especially when the numbers are close. Here's why this model is different. First, finance experts agree that using net present value is the best way to analyze financial decisions like this, but not all calculators incorporate this method. Second, the model doesn't just compare lease versus buy, it also looks at lease return versus lease buyout and refinance. These are realistic scenarios that other calculators overlook. Third, the model also separates payment relief from ending balance. Lower payments may be important, but taking advantage of lease residual and market value disparities may provide economic benefit that a straight purchase or a simple lease and return do not provide. And finally, in this model, everything is transparent. The assumptions are clear, and you can drill into the calculations if you want. Well, that's it for today. You can download the model and a demo workbook using the link below. It includes a quick start guide and the example you just saw. Plug in your own numbers and get an accurate answer fast. If this was informative, hit like and subscribe. I'll be posting more decision tools soon. I'm Joseph Folco for Folco Financial. Thanks for watching.